Hi, I'm Chris Vavra. I'm the senior editor for WTWH Media, here live at Automate 2024 for the third day of this fine event here in Chicago. And I'm pleased to be joined with Alex Chausovsky from Bundy Group, one of our content partners who is very involved in the mergers and acquisitions world of automation, system integration, and manufacturing. Thanks for joining me, Alex.
Thanks so much for having me. It's a pleasure to be here.
Yeah. Glad to have you here. So, I know you haven't been here at Automate too long, but have you heard any like trends or rumors, or what's been kind of the trend you've been hearing so far at Automate from your perspective?
Yeah, so my background is obviously more econometrics and data analysis, and there's a lot of interesting conversations happening around what's happening with interest rates and the cost of capital and how that's affecting the ability of users to invest in robots. Obviously, not a cheap item to invest in. And so several of the conversations I've had have been around this idea of robotics as a service, allowing companies to pay per pick or pay per use of the robot rather than shelling out hundreds of thousands or millions of dollars to buy the machine up front. And I think there's some real traction to this space because, as you know, interest rates are high, the cost of borrowing is prohibitive in some places. And so the ability for companies to have an lower cost entry point into the robotics field, into the automation field, is something that's very attractive to the CFOs of all the manufacturing organizations out there.
And on top of that, this allows companies that might not have been, sold on the idea of robotics. It's almost like a pilot run. It's like, well, we don't want to spend $100,000, but if we pay, a quarter of that, it's easier, isn't it, to kind of get as a proof of concept, like, well, this is what it would look like if we really invested.
Yeah, that's exactly right. And there are multiple additional benefits. For example, you can roll in the maintenance and the software updates and all of the upkeep of the robot into that monthly low payment cost, therefore kind of taking the headache away from the operators of the robots. So it's a win-win scenario as far as I can see.
Yeah, and as robots get more sophisticated, they'll be able to. As the price point goes down, it's going to be interesting to see what happens as far as where this trend goes with RAS. And as a service in general, we're seeing it all across the industry. Software, robots, you name it, you can have as a service for it. Do you see that happening with some of the other industries as well?
Yeah, a great example of that is actually the aerospace sector, where you see companies leasing planes and engines because they're high capital equipment costs. And so a low monthly cost as a maintenance of that cost structure, I think, is very beneficial. And so it's replicated in other sectors already. You mentioned software, great example. All of the office products that we use on a day-to-day basis, from Microsoft, we're now paying monthly costs instead of buying the software outright. And so I think this is an idea that's going to proliferate to many industries in the coming years.
Yeah, and kind of going a little bit more on the macro level, have you seen any trends in the mergers and acquisitions so far in 2024? Has there been a trend line so far? If so, has it been a surprising one, or is it about what you expected at Bundy Group?
Yeah, so I would say that the biggest observation I can make right now is there is still a lot of interest in automation, particularly companies, anything dealing with robotics. We have a bit of a shift that happened last year, which is where private equity took a bit of a back seat and more strategic acquirers were prominent. You had fewer of the very large deals, more of the smaller deals. But I think the key element here to communicate is no matter what's going on in the business cycle or with the cost of capital, the companies that are going to have all of the four key elements of what makes a business valuable are still going to transact regardless of what's going on in the economy. And those four legs are very important. This is something that we talk to all of our clients about, which is, of course, you've got to have stability of revenue. You have to be a profitable business. You can't be losing money. You have to have growth that's consistent, and you have to have some scale. So you can't be startup phase. You've got to actually have, a few $1 million worth of EBITDA before the market actually finds value in your business. One other element that I've been stressing recently is the diversification. You have to have a diversified mix of customers, exposure to multiple verticals, and a diverse and well-seasoned management team that goes just beyond the owner. It has to be able to survive the departure of the founder and the owner of the company. And if you have all of these elements in place, then the market finds your business very valuable and you'll get a premium multiple.
Case in point, Siemens buying EBM Pabst about a month ago for $3 billion. That's a fairly high-profile acquisition, but it's also a fairly strategic one, isn't it?
It is, and I think that Siemens is playing the game of motion control more than it is on the traditional motor side. You see that they sold their traditional motors business, the induction motor business, the larger, more industrial motors recently, but they are acquiring kind of the the elements that are involved in robotics and involved in precise control. And I do think it's strategic on the part of Siemens in order to get more access with a well-established brand name and EBM Pabst. They're also obviously prevalent in some of the end-use markets, the fans, the pumps, the compressors that are being run on these, and the miniaturization of technology, I think, is a big theme that Siemens is following here, and it's very evident in this acquisition.
When you talk about robotics, they're getting smaller all the time and getting more strategic and getting more, diverse in their applications. So you're kind of seeing it. You see it with all these companies, behind us here. You got your Beckoffs, your SEW Eurodrives of the world. They're all being very strategic in what they do next, and trying to find, not so much their niche, but expanding their portfolio, right?
Yeah, that's exactly right. And I think the idea that's very strong right now is we don't want to have all of our eggs in one basket. So if you've been historically preferring a specific set of industries, the idea of diversifying into new sectors, particularly ones that promise a lot of growth in the future, such as robotics, is very appealing. And so that's why I go back to that Siemens example. Buying a servo motors business versus the traditional induction motors makes a lot of sense because they're trying to play on those sectors that are going to be benefiting from the movement in technology.
And overall, there's been the general consensus we're heading for kind of a downward swing in 2024. It's kind of an after effect of the high that we had in 21 and 22. Now with interest rates and just general trepidation, within the economy. But from what I've been hearing, there's still a general sense of optimism because they know the storm will pass and it won't be too bad. And 2025 will be better. Is that true?
Yeah, that certainly matches my expectations. So I think that there's a little bit of a misnomer in the sense that things are not good right now. We have slowed in terms of the growth that we're seeing, but that slowing was always going to happen because the levels of activity and the level of demand that we saw in 21 and 22, to your point, were never going to be sustainable long term. It was called reciprocal pressure coming off of that low point during COVID. And so the fact that we are normalized now, the fact that our supply chain can actually keep up with the order intake and that backlogs are starting to come back to regular levels, I think is a really good sign. But at the same time, I'll say, GDP through the first quarter of this year is at a record high. And so the economy is still growing 3% a year. It doesn't reflect in sentiment. People have a very negative outlook on things, but the data says the economy is actually doing quite well right now.
It's an interesting paradox that will play itself out, I think, over the next couple of years as the market kind of resets and kind of comes to a new normal in the wake of COVID-19, much in the same way, I suppose, after the Great Recession, we saw the same kind of cycle, right?
Yes, very, very similar in that sense in terms of the normalization patterns that we're seeing. I do think it's important to identify that there is a difference between the consumer side of the economy, which is more like businesses selling to people, versus the B2B side, industrial production being a good example of that. We're definitely seeing some downside pressure on the industrial economy because of the high cost of capital, because of limited capital investment that's going on right now. But the leading indicators that are follow, and in particular, the Purchasing Managers Index, which tends to lead economic activity by about a year, says by the end of 2024, we should start to see a tangible rising trend occur, and 2025 will be substantially better than what we're seeing this year.
Well, here's hoping, because we could use some positive sentiment in the economy these days. But, well, thank you very much, Alex. I appreciate your insights today and your continued partnership on behalf of Bundy Group for control engineering and plant engineering. So thank you very much.
My pleasure, Chris. Thanks for having me.
All right. If you enjoyed this video, we have other insights from Automate 2024 from other thought leaders. And you can also find YouTube shorts and articles as well relating to this event. And if you like our channel, Control Eng TV, please be sure to give it a subscribe. And I'm Chris Vavra, Senior Editor, WTWH Media, on behalf of Control Engineering and Plant Engineering. Thank you for watching. See you next time.